In this session, we will analyze whether averaging in stocks is a good idea or a bad idea. So what is averaging, or averaging down as some people call it? Averaging is basically to keep buying shares of a falling stock so that your average buying price comes down. Let's say you originally bought a stock at 100 rupees and it falls down to 90. What do? You buy more. Because of that, now your average buying price has come down to 95. That is 100 plus 90 divided by 2. Now let's say the stock crashes down to 70 and you bought again. Now your average price has come down to 87. That is 100 plus 90 plus 70 divided by 3. See, the basic idea in averaging is to keep getting the average buying price down so that when the stock bounces back up, you can get an earlier exit. Sounds like a logical way to get out of a hairy situation, right? Averaging is a very common practice among traders and investors. You will get advice to average from TV pundits, other traders on the internet forums, and probably from your own friends and family. However, averaging is not as innocent as you think. In fact, averaging is one of the leading reasons of loss in the stock market. And I'm talking big losses here. In order to understand why averaging is dangerous, let's compare how rookies and pros look at averaging. First, we'll start with the rookie. Rookie buys on hope. The moment he buys a stock, he hopes that it will fly like a rocket and it will start raining money. A rookie has no idea where the stock's key support and resistances are. He doesn't know the key support levels, which when broken can cause the stock to fall down further. The bottom line is that rookies are only prepared to see the stock go up. So when the stock does go up, rookie parties, and boy does he know how to party. Look at him. But he never imagines that the stock might go against him as well. He always thinks that the stock is not going to fall more than a few percentage points, as if his buying has somehow graced the stock with some supernatural powers. So when the stock does fall, and fall rather drastically, he reacts emotionally, not rationally, emotionally. What is he going to do now? He doesn't have any strategy. He doesn't have any plan of action, nor does he have any idea how to deal with such a situation. At this point, he has two options. Number one, accept that the trade was a mistake, take the losses and look for better trading opportunities in other stocks. Or number two, keep averaging at every dip and hope that the stock will recover at some time. The hardest part in stock market is to take a loss, and that too willingly. The rookie doesn't have the guts to accept the mistake, take the loss and move on. So in this moment of gloom and confusion, he decides to go with option number 2, that is to keep averaging. In psychology, this mindset is also called sunk cost fallacy. What that is essentially committing more and more money to the previously failed actions just because we are emotionally invested in it. What the rookie doesn't realize is that a stock that has fallen 10% can even fall 20%. A stock that has fallen 20% can fall 50%. A stock that has fallen 50% can go down burning and can become a worthless penny stock. I'm sure some of you have been in this situation. If not, just turn on any TV business channel. There is always someone with a horror story of averaging. Let's take some real life examples to see what I'm talking about. Vakrangi fell from 500 rupees to 50 rupees. 90% fall. How far could he have averaged this stock? Unitech fell like a rock from 500 rupees to 5 rupees. Fell down 99%. A retail trader can never have enough money to bail out this piece of garbage. Or let's take JP Associates, another jewel of a stock. Same story. And of course, who can forget the genius Anil Ambani's flagship company, Reliance Communications. Now, you can say, sir, these are exceptions. Most of these stocks bounce back after the fall, and averaging helps us to come out of these stocks quickly. I agree to that to a certain extent. Not every stock will burn down to the ground. But how do you know your stock wouldn't? Don't you think the investors of Vakrangi, Unitech, JP Associates, Reliance Communication, and I can go on and on and on, they all thought in the same way? All you need is one bad trade to put a serious dent into your trading capital. Leave aside that as well. I have two objections to averaging. My first objection is the escalation of risk. At first, the rookie was taking a loss on 1 lakh rupees. But now that he has escalated his commitment to the stock, he is going to take a loss at 3.5 lakh rupees. So now he has made his situation 3.5 times worse. See, trading is an art of listening to the market. See, when the market says, dude, the stock is a dud, just accept the mistake and move on. Instead, rookies tend to fight with the market. When they get hurt on 1 lakh rupees, they try to fight back with 3 lakh rupees or 4 lakh rupees or 5 lakh rupees as if the market cares. Not listening to the market is a perfect way of getting killed here. My second objection is the sheer stupidity of throwing good money after bad. By falling steeply, this particular stock has already proven to be a loser. Why would you throw money behind a loser? Why run after JP Associate kind of a stock when you have HDFC Bank or TCS to invest money into? Okay, so now we have seen how the rookies think. Let's see how pros approach the same situation. Pros buy on analysis. They think through all the scenarios, the good, the bad, and the ugly. They know exactly what they will do when the stock goes up, when the stock goes down, or when it starts falling like a rock. This is important. Pros know the key support and resistances of their stocks. They know which supports, when broken, would signal them to get out in time. For trading, pros never average. Yes, I have never met a successful trader who made money by averaging a losing position. For investing, pros do average, but they plan this before even putting a single dollar into the trade. So it all boils down to whether you are listening to the market or you are fighting with the market. I have taken a couple of case studies in the next video to explain these points more clearly. But let's just summarize what we have learned so far. Averaging means to keep buying a stock at lower levels. The idea behind averaging is to bring the average buying price down so that the investor or the trader can get an earlier exit. As we saw, averaging can be really dangerous because of the escalation of risk and commitment. The only acceptable use of averaging is in investing, where a savvy investor accumulates a stock over a period of several months or years. Alright guys, I hope you understand the concept of averaging now and the risks associated with them.